Now that we have reviewed the 4 fundamental styles that traders most commonly take on, we can take a look at some rather unconventional trading methods. This is going to include algorithmic trading, otherwise known as algo trading, which involves a system or algorithm that is pre-programmed based on your personal strategy and conditions, which essentially trades for you. This is the basic idea behind algo trading, that trading as a technical process is fully automated. This means that every decision and execution is going to be done through a computerized system, becoming a fully passive source of income. Since trading is very mechanical in nature, it is often a common belief that trading can be automated. We also understand that behavioral inconsistencies within the trader can drastically hinder their profitability, which is something of a human quality. If we can remove this quality altogether with the utilization of technology, trading can potentially become significantly more stable as a source of income, which in nature is not. When programming our strategy, rules, and instructions into an algorithm, it also diminishes the idea behind decision fatigue. Since there is no limit on the capacity or capabilities of technology when making decisions, the algorithm can trade non-stop, which can allow it to take best advantage of the capital at hand. While this all sounds great, it almost sounds too great. It is often iterated that if something sounds too good to be true, it probably is. Unfortunately, this aphorism does hold truth in regards to trading automation. So with that said, let's get straight into the reasons why automating your trading may not be the best means to achieving success. Similar to any market, the world of trading is one of the most difficult and unnatural areas to find consistency in. Many theories, such as the efficient market hypothesis, the random walk theory, or the market microstructure theory, help us better understand that we understand so little. Prediction in any endeavor becomes exponentially more difficult as more factors come into consideration. When taking a look at the financial markets, every participant and potential participant is a factor to consider. As we know, financial markets are generally publicly available, which allows for virtually all consumers to engage in market activity. This makes it virtually impossible to understand all factors that may affect price in a given market, which is okay, since we can look at more major factors and blur out the smaller ones. With enough time and practice, this can be done quite well with humans, but it is an entirely different story with algorithms. When introducing fixed scenarios, algorithms can be exponentially better than humans at nearly any endeavor. This is due to numerous factors, one being speed. Algorithms can process information and execute tasks at a near instantaneous basis, as opposed to people who require more time to perform optimally. Algorithms are also consistent, and while people can become very consistent, it is impossible for us to cure boredom, tiredness, and distractions. Algorithms also have a near infinite storage of memory, which means they can access and process massive amounts of data in any given time, allowing the best possible outcomes in any given situation. Other factors, such as the scalability and adaptation of algorithms, also beats the human mind by a fair margin, but I think the point has been made. Algorithms, and computers at that, are simply more efficient than humans. The problem with this? The financial markets are not mechanical, at least not as mechanical as you might think. While algorithms are almost always a better option as opposed to humans, this is only in regards to fixed situations. When it comes to the financial markets, nothing is fixed. Everything is constantly moving, changing, and adapting in ways which are entirely unique within that moment, making it extremely difficult to program a successful trading strategy, that being a trading strategy that is successful in the long term. While it is not necessarily difficult to automate a trading strategy for short-term profits, it becomes exponentially more difficult to find longevity in this process. A simple solution, on paper, is to continuously test and further optimize the algorithm until it works properly. The problem with this is that markets are often changing and adapting at a constant basis, which means that the optimization that you had implemented into your algorithm may become completely useless in the following week. Of course, you can continue to refine and optimize your system for it to achieve better results, but this could be an ongoing pursuit, which ultimately compromises the entire purpose of an algorithm to begin with. So, while the trading algorithm can be profitable for a short while, it is likely not going to be able to sustain that profitability and will become more so of a liability than anything. The bottom line is that algorithms are not able to adapt or learn based on new experiences. Since the financial markets are so dynamic, an entirely technical approach is not necessarily optimal. Although, this is not to say that there are zero successful trading algorithms out there. Many large institutions, banks, and financial corporations use algorithmic trading to help execute more efficiently, locate liquidity imbalances, manipulate liquidity, and can also be used when trading in high frequency. That being said, these algorithms have often been optimized for many years and done so by the best in the business. But I am also not implying that it is impossible for a retail trader, like you and I, to create a consistently profitable automated trading system. With coding experience, determination, knowledge, and some passion, you, and anyone with the will to take on the challenge of developing your own personal trading algorithm, can be done. Before we move on, I would also like to talk about the utilization of external algorithms not created by you. Of course, everything has a cost, so it is most definitely an option to actually purchase these algorithms rather than make it yourself. If money is not an issue, this can potentially save you all of the time and emotional commitment that may come from learning how to trade, which of course would not be necessary when automated. Now, this of course is considering that the trading algorithm actually works. If you do some brief research on trading algorithms for sale, you will find dozens, if not hundreds out there that guarantee success. The problem with these algorithms is again, not that it isn't profitable, but more so that it isn't profitable long term. This is a risk you must consider when taking the easy approach, so to speak, as the algorithm could be a dud. It is also important to recognize that these algorithms are not cheap. Some may go for tens of thousands of dollars, which once again, may not work long term and may not work at all. Now, something else you may consider is purchasing an algorithm as a foundation to further optimize on yourself. While this sounds good in theory, most algorithms are not sold open sourced, meaning if there is any fault or flaw within the algorithm that you find or would like to change, there is nothing you can do to resolve that issue. If you do happen to choose this automated approach of trading, it is probably best to develop your own algorithm with your own parameters. This makes it significantly easier to optimize and iterate if and when the system begins to develop flaws. Still, this is going to require a substantial amount of coding knowledge and, of course, knowledge on the financial markets in general. But if you are able to successfully develop an automated system, you have essentially developed an infinite money glitch. Also, if it is truly a profitable system, others will likely find value in it too. They say that it is not the money that you can make from developing a successful trading algorithm, it is the money that you can make from selling it.